Guys, so how is everybody today? Just before we jump in here, can everyone hear me now? Can everyone hear me loud and clear? Trader? Great. So we're going to be talking today about something called unusual options activity. Okay, so what is unusual options activity? How many of you have ever heard the term unusual options activity, either in the news or have read about it before? How many of you ever heard that term? Yeah, Nigerian. The Nigerians talk about it all of the time, okay? And the idea of unusual option activity and the idea behind unusual option activity has really started to become more prolific in the trading world, okay? And why is that? It's because, we've had a bit of a rash of insider trading cases recently, and a lot of those have been surrounding specifically trades that were conducted in the equity options market, all right? So I don't believe that insider trading is something that should happen, right? I'm not saying that it's a good thing at all. But what I am saying is that if a trader can recognize what institutional order flow looks like and can flag the more suspicious-looking orders, they are able to hone in on trades that perhaps are being taken with knowledge that a trader shouldn't have, okay? I don't believe that, very many of the unusual option activity orders that we see on a regular basis are based off of illegal or insider information, but some of them are. We're going to talk about all of the reasons why, outside of that, I want to be paying attention to unusual option activity and what I can use it for, at least what type of information I can glean from it to then translate that into a profitable trading plan, okay? So before we get started, I do need to read our risk disclaimer here. Day trading, short-term trading, options trading, and future trading are extremely risky undertakings and are generally not appropriate for someone with limited capital, little or no trading experience, and or low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades are recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution, margin, and other capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and KeeneOnTheMarket.com. All right, well, before we jump into the actual meat and potatoes of the presentation, let me tell you a little bit about myself. My name is James Ramelli. I'm a trader and moderator here at KeeneOnTheMarket.com. I actively trade stocks, futures, forex, commodities, but 95% of all of the trades that I conduct on a daily basis are going to be in the equity options market. I'm regularly on CNBC, Bloomberg, Fox Business, BNN Canada, so maybe you've seen me on TV. If you haven't, maybe you've read something I've written. I write for Futures Mag, Active Trader Mag, Resource Investor Mag, and CME Open Markets Magazine. But enough about me. Let's talk a little bit here about the philosophy behind following unusual options activity and the philosophy behind the trading plan that we wrote to go along with it. So 90% of all retail traders lose money in the long run. And someone told me the other day that they believe this statistic might be a little bit different now, and roughly only 75% of retail traders are losing money, but that's still the vast, vast majority. Okay, and the problem is that trading is kind of something that requires you to go against standard human instinct or standard human intuition, right? Your first instinct always feels right. So if I'm someone who looks at a trade in something like a long stock position in Apple, and I buy that stock and I see it sell off after earnings, well, now in my mind, I think that my first instinct should be right, and that Apple now represents a better value now that it's cheaper, okay? That's not necessarily the way that we like to trade, and it's not necessarily the way that retail traders should be trading, okay? It's very, very easy to kind of try and convince yourself that you were right in the first place, and it's difficult to cut losses or take gains when you should. So all of our trading plans are written very specifically trying to help curb that, drag that most traders have in their book. Okay, so it is a sad statistic that only 1 in 10 traders is profitable over time, but I believe that if they are able to do something like follow this unusual option activity, that they can start to put themselves in the camp outside of these retail trader statistics, right, and be more on the side of the success rates that institutions tend to experience. I can tell you guys that there's years, and in the past like 3 years, I believe Virtu Financial, they were going to go public, but did not last year, chose not to. But in 5 years, did not have a losing trading day. Okay, is that because they're smarter than everyone else? Are they really that much smarter than everybody else, or do they have some type of advantage? So we're going to talk about what those advantages might be and how I can use their advantages to my advantage just by being able to follow unusual option activity and read institutional order flow. Okay, so Paul Tudor Jones once said that the key to trading success is emotional discipline. Okay, the key to success is emotional discipline. So how many of you here have never heard of Paul Tudor Jones, or how many of you have heard of Paul Tudor Jones? If you haven't, he is a wildly, wildly successful hedge fund manager, probably one of the best traders around. Okay, probably one of the best traders in the world. So, is that really, right, he's a trading god, exactly. So is that really the key to his success? Now, I truly believe that emotional discipline is one of the most important parts of any trading plan, right? If I don't stick to my plan and I allow myself to get emotional, it doesn't really matter how much edge I have in my trading plan. If I can't follow it, then it doesn't matter, okay? But is Paul Tudor Jones really the trading god that we all think he is because of the amount of emotional discipline he has? Or, does being who he is now kind of help him along, and being an institution help him along? So is it really that easy for him? When he makes money now, what other advantages does he have as an institutional trader? Well, an institutional trader from a hedge fund, a mutual fund, big bank, sovereign wealth fund, pension fund, any of those would be considered institutional traders. What advantages do they have? What advantages do they have over guys at home who are trying to make a living doing this trading day in and day out? Well, for one, they have better access to information. Whether or not that information is non-public or public information, they have better access to it. Even public information is more available to institutional traders than it is to retail traders at home like me and you, okay? The sheer size and capital that they have behind them means that they can afford much better technology and much better analysis of that information, okay? We all know just how much money is spent on financial data by institutions every year, okay? They have access to something that I do not. One thing that they also have access to, and one ability that they have that I can never, ever replicate, is the amount of manpower that they have. No matter what I do, I'm always going to be one person. I mean, just shout out some numbers here. How many hours a week outside of trading hours do you guys spend doing analysis and looking at charts? How many hours a week? Roughly, if you had to make a guess, roughly how much time do you think you spend outside of trading hours, looking at charts, doing analysis? Some of you are saying none. Some are saying 4 or 5 hours. Some people saying as much as 20 hours. But most of you are saying 4 or 5 hours. Like 10 people said 4 or 5 hours. Okay? And trying to spend 20 hours a week or more doing that is very difficult if you're someone who is a retail trader. Okay? And especially if you're one person. Right? No matter what I do, I can never work more than one person can work. I can never spend more time than there are hours in a day, okay? They have teams of analysts, quants, and people with very expensive educations and a lot of knowledge pouring over data all of the time, okay? All of their capital allows them to do this, allows them to pay for all of this and get access to it. So that is why they have edge, right? So nothing in what I just said accuses these institutions of having insider information. Now, I believe that a lot of them do, and we're going to look at some trades here as examples of unusual option activity a little bit later that are going to show you that they pretty clearly, or it's fairly obvious that they did have some type of insider information ahead of these trades. But even if I believe that everyone is following the rules and obeying the law and not using non-public information, the fact that they're that large and have access to all of these things that I do not means that their order flow is important, okay? It's important for me to be able to see what it is they are doing in the equity options market. Okay, so that brings us to unusual options activity. Unusual options activity really is a window into the money flow of these institutions and these large organizations that are participating in the equity options market. Okay, so unusual options activity is driven by institutional order flow. Any order that is above the average daily volume in options in a given stock is considered unusual options activity. And these orders give us insight into institutional order flow, and they let me see where the smart money is betting in the options market. Okay? Now, smart money, quote unquote, you may or may not believe that hedge funds or mutual funds know what they're doing, but they do have access and technology that we do not. So it's important for me to be able to see what their orders look like, okay? So there's a lot of noise that comes across the tape in a given day. So what is really important is for me to be able to kind of filter out the differences between speculative bets and hedges. So there's two main participants in the equity options market, even on the institutional side. There are institutions who are coming in to speculate on positions, and there are institutions who are coming in to hedge positions that they already have, okay? Those are the two main participants in the equity options market. Now, I'm not so much concerned with the hedgers. That doesn't really matter to me. They have an underlying position in something else, and they're using equity options to hedge their exposure either to the direction, either to time decay, or either to implied volatility in that given name. I don't really care about that order flow. What I want to pay attention to is speculative order flow, okay? Why is that? Well, I don't want to buy a hedge that an institutional trader is buying just because they think it's not going to work out. That's not their market view, right? If they're a long stock and they're buying puts to protect themselves, well, they're not thinking the stock's going to go lower. They're just buying some protection. If they buy calls expecting a stock to go higher, well, then that's the type of order that I want to follow. Okay, so you have to understand that when we see orders hitting the tape, meaning a big block of calls being bought, a big block of calls being sold, a big block of puts being bought, a big block of puts being sold, that I can't just automatically take that trade at face value. So if a trader buys calls, it could be speculation to the upside, and most times it is, but it could also be a hedge against short stock position. All right, same thing when a trader sells calls. It can be speculation to the downside, but covered call strategy is extremely popular, and it's used very widely by institutions to create dividend streams in stocks that either do not pay dividends or stocks they want to create an extra dividend stream in. Okay? If a trader buys puts, actually most of the time when we see large blocks of puts being bought, they are not being bought by institutions trying to get short. They are being bought by institutions that are long the stock market and want to hedge. There aren't any mutual funds that are short only. There are very few hedge funds that are short only. Most of them are long the market. In general, participants in the stock market are long the market. Okay? Yes, institutions move the market with these giant blocks. Okay, so that's why it's important to follow them. So I should have said this at the very beginning. If you guys have any questions whatsoever as we go through this, please just interrupt me and ask. I'd much rather stop and answer a question than kind of go through the rest of the presentation with someone who's confused. With the number of people in here, I guarantee there'd be more than one person who has the exact same question. So where are these orders? So we're going to look at that. We're going to look at that in a little bit here. Don't worry. So any trade can be a speculative bet or a hedge. A big part of the trading plan is figuring out which scenario is more probable. Okay. Which scenario is more probable? So, first I have to understand that 70% of the time when a trader buys calls, they are probably getting long. 30% of the time, it's most likely hedging against a short stock position. Now, I can, make a guess, or I can use a systematic method to determine whether or not there is a chance that it's a hedge or a speculative bet. Okay, so when I am looking at these things, I have different things that I look at, all right? And the chart is a really big part of this. I am not that much, or at least I wouldn't have considered myself much of a technician when I started to trade unusual options activity. But then I realized how important it was to incorporate good analysis of charts into this to help determine which bets are more likely to be speculative, okay? Because if I'm looking at a chart And let's say I see a giant block of calls hit the tape. I see a huge block of calls hit the tape. And then I look at a chart. Well, if I have a chart that looks like this, stock moving higher, is it more likely they're playing with this, playing with the direction, or is it more likely that they're coming in and shorting this and buying calls as a hedge? Let's say I see that same block of calls bought in a stock with a chart that looks like this. Well, I'm much more likely to believe that this order here is a hedge and this one is a speculative bet, right? The chart tells me where the momentum is and what the direction of the general trend is. Typically speaking, institutional traders are not coming in and trying to call bottoms or call tops or pick bottoms in stocks. Typically, that's not what they're doing. They try and trade with momentum and with trend. Okay, so understanding that simple fact helps me determine whether or not orders are speculative or whether or not they are hedges. Traders will use all types of strategies in the options market to hedge positions and to take speculative bets. Okay, one thing that I also need to understand is that a trade that hits the tape might be a speculative bet, but it might not be speculating necessarily on the direction of the stock. Institutions and hedge funds in particular employ very complex strategies all the time, and these strategies and spreads that they trade oftentimes are not taking a view necessarily on the direction of the stock, but on something like implied volatility or time. Okay, all of these things I need to consider when watching order flow. Okay, so let's take a look at an example of what an order hitting the tape might look like. So here we see a trade hitting the tape in ALTR, and the way that I would read this is a trader bought 2,958 ALTR April 36 strike calls for 35 cents when the market was 25 cents at 35 cents. Okay, so I see a lot here of information in this order. So it can be a little bit, overwhelming. Oh my gosh. So it can be a little bit overwhelming initially. But what we see here is pretty simple, right? All the information that I need to start making the determination of whether or not this is a speculative bet or a hedge is right here in front of me. The first thing I see, the trade size, okay? 2,958 contracts. The symbol, expiration, strike, whether it was a call or a put, and the price it traded at, all right? Then this is the next most important part right here. The bid and offer at the time of the trade, okay? I can see that the market was 25 cents at 35 cents. So when I see them pay 35 cents to get into this position, I know that it is a buy. I know that they are buying these calls, okay? They didn't come in and try and work an order mid-market and get filled at 30 cents. They decided to come in and lift the market maker's offer and get into this position, okay? So it also tells me that it's a little bit more aggressive of a trade. Then I can see whether or not it was an opening or closing position. This is one of the most important things that I need to determine every time I see an order hitting the tape. If a trade is not an opening position, then I do not want to be taking it. Okay, that's simple logic, right? If I think that institutions know better than me, I want to be getting into the positions when they are, not getting out or not getting in when they're getting out, okay? So we're going to talk about what you can do if an order isn't labeled opening, how you can determine whether or not it was opening or closing. What does a sweep mean? So a sweep is a order that is sent through multiple exchange centers. So when a trader wants to get filled on an order of size like this, 3,000 contracts, they have to take out all of the offers at every single exchange, an intermarket sweep, to get filled before they can trade higher, okay? So it shows more aggression. It shows more aggressive buying. It shows more aggressive buying when it's labeled a sweep, okay? So let's talk a little bit about how these orders are executed, because it's important to understand how they're actually executed to know why it is I want to be following them, okay? So an institution will create an order based on research, information, and analysis that they have. And as I've already illustrated and talked about, that amount of research, information, and analysis is a lot more than I can ever come close to. Okay, it's really, really difficult for me to spend as much time or put as much put as many hours into a trade idea as a hedge fund with a desk of 25 analysts is going to be able to do. Okay? So they have their trade idea. They spend time, a ton of work goes into it. A lot of smart people sit around and figure out what strategy it is they want to execute in the equity options market. Then they will call their brokerage to get the trade executed. Their broker will then shop the trade around to desks all over the place, Citadel, Goldman, Barclays, what have you. If they can't get filled there, then they'll send the order to the pit, and the market maker can trade it there. If no one in the pit wants to trade the order, well, then the broker might take the other side of the trade themselves and execute the trade for their customer, hedge it, and move on. But what's really, really important to understand here is that a lot of time went into those orders, right? A lot of time and a lot of analysis. But what's even more important is that at no point does this institutional trader have the ability to trade this volume off of the exchange. Okay? If I am a hedge fund that's trading equities, what's more likely? Is it more likely that I go to a public exchange like the NYSE and fill my order for a big block of stock on a public exchange, or is it more likely I pick up the phone and call a market maker like Citadel or Goldman and have that order filled off of the exchange in a dark pool, right? It's much more likely if I'm an equity trader that I have that order filled off of the exchange in a dark pool, right? I can hide my order flow there. I can kind of hide what it is that I'm trying to do, and none of that volume gets reported in public exchanges, and nobody who is looking at the data flow from the exchange is able to see it. Okay? Equity options traders don't have that option available to them. All of the orders have to go through a public exchange. So what that means is that institutional traders can't hide their orders like they do in the stock market. They can't hide their equity options orders. Every single time they want to put a block trade on, I'm going to see that order hit the tape. Okay? So it's very easy for them to hide their intentions in the stock market because they can just take their volume off the exchange. It's a lot more difficult for them to do that in equity options. Okay? So let's take a look again at that ALTR example. So this trade hit the tape on March 27th with less than an hour to go to the close. Shortly after the trade hit the tape, the stock got halted and ripped higher on M&A news. Okay, so we're going to look at the chart here in a second so you can see how the stock performed. But, it doesn't really take a genius to take a look at this and say, hey, there's something here that is kind of suspicious. How many of you here would look at this order, and I'm telling you, this order hit the tape, and moments later the stock got halted and ripped higher? How many of you would look at this order and say, well, this person just got lucky? Or how many of you would say, no, they knew something was going to happen. They knew this announcement was going to happen and wanted to make money, so they went and bought out of the money calls. Right, they knew. They knew. They obviously knew. In this case, this is a really good example of unusual options activity ahead of a merger and acquisition announcement. Okay, now you might not think that happens all that often, right? The SEC should really kind of be on this, right? People aren't going to be doing this when they know it's this obvious and they're going to get caught. It doesn't really happen. It doesn't really happen, right? We don't really see that many people get in trouble for trading like this. All right, so whatever it is that they knew doesn't really matter to me. Okay, if they got lucky and just so happened to buy this block of calls ahead of this news, good for them. If they knew something that they weren't supposed to and bought these calls ahead of that news and made money, well, good for them, but they better get a good lawyer. Regardless of what it was, it doesn't really matter, because if I'm able to recognize it as an unusual trade, if I'm able to see this order and say, hey, this is suspicious, I kind of want to, I want to follow this type of trade, it doesn't matter, because as soon as that order hits the tape, it becomes public information. It becomes publicly available information, and it becomes part of all public information available to traders that they are able to use in their analysis and then make a trade on, okay? So whatever they knew doesn't really matter. Whatever they knew does not really matter. Someone says, do you follow orders at the bid or the ask, or is it not? So yeah, typically when we're looking at unusual options activity, the most aggressive orders are ones that trade on the bid or the offer. All right, so anything mid-market, it's a lot more difficult to determine whether or not it was a buy or a sell, and it also shows me that the trader wasn't quite as aggressive, right? It also shows me that the trader wasn't quite as aggressive. All right, so another thing to consider, past whether or not they knew something, is that orders like this, and someone asked a little bit earlier here, can this order cause the stock to rip on its own, all right? And this is where we kind of start to talk about volume in the stock. For very thinly traded stocks, unusual options activity, the order itself can have a much more pronounced effect on the price of the stock, right? And someone says here that's exactly the right answer, due to hedging, okay? So let me lay out a scenario like this for you. I have stock XYZ that trades on average 200,000 shares a day. Then I see someone come in and they buy 10,000 out of the money calls with a 25 delta in stock XYZ. Well, the market maker that sold them those calls is going to hedge himself now. So on 10,000 calls that he's short on a 25 delta, how many shares of stock does he have to buy to completely hedge himself in that position? Not 1 million shares. Even if he's hedging it perfectly, he would do 1 million. But if he's hedging it on the delta, he'd buy 250,000 shares. Exactly right. 250,000 shares. Now, if the stock only trades 200,000 shares a day, well, he has a lot of stock to buy during that day, and it's going to have a lot more pronounced effect than in a stock that trades 1 million shares a day or more, right? So when we talk about unusual options activity, we pretty much assume that there is no such thing as unusual options activity in a stock like Apple, or in a symbol like Apple, Facebook, Tesla, Alibaba, GE, things like that, right? Because those trade so many shares of stock in a day that the participants in that market, to really kind of know something ahead of time, their order flow is going to get lost. It's going to be very insignificant, even if it's a 10,000 lot, okay? So does everyone follow along so far? Does everyone follow along so far? So this ALTR trade hit the tape, and then the stock was halted, and it ripped higher on news, okay? The stock was halted and it ripped higher on news. So it hit the tape right in this bar here. Stock was starting to rip higher. Hit the tape right here in this bar. Then stock's halted. It opens up a few minutes later and rips higher, okay? It was announced that Intel was going to be buying this company. I think that deal has since fallen through. It doesn't really matter. But this is a really good example of unusual options activity telegraphing a move in a stock like this, okay? And it was said, and this was a report that came out last year, Andrew Ross Sorkin, who's a relatively respected financial journalist, wrote a report that said, hey, a study just showed that this happens a lot more often than we think it does. If we go back and take a look at all of the M&A deals over the past 10 years and take a look at what the options order flow was like ahead of those merger and acquisitions deals, well, 30% of the time there is some type of telegraphing unusual options activity. So almost 1/3 of all deals that go down have some type of unusual options activity ahead of them. Okay, so that just goes to show you that, hey, if I'm paying attention to this, I can really find some huge home runs with positions like this ahead of merger and acquisition deals. Now, not every trade is going to be like this, okay? Not every trade is going to be like this. I don't want you guys to think that every single time that an unusual options activity trade hits the tape, that the stock then explodes 10% to the upside, okay? I'll show you guys some examples here at the end of some more modest returns that are much more typical, that we see happen a lot more often, okay? So, what happened to this trade? Well, let me erase that drawing there too. So what happened to this trade? Well, the stock continued higher on Monday. This happened on a Friday, by the way. The stock continued higher on Monday, and the calls traded as high as $7 since then. All right, if a trader bought 20 of those, risking $700, they would have profited over $13,000 at the highs. So that's a really good example of unusual options activity ahead of merger and acquisition deals. On Fridays, so today, even as I'm speaking to you guys right now, I have in the corner of my screen, I have the tape, and I'm waiting to see if there's anything suspicious that hits on Friday. A lot of times, and this ALTR trade is a really good example of that, a lot of times when traders are thinking, or when institutional traders think or know that something's going to be happening, they will try and put a trade on Friday ahead of a potential deal over the weekend. All right, so that's why this order was even more significant. It had that type of, deal speculation feel to it, right? Short expiration ahead of the weekend, 20 minutes into the close, and that's the reaction that we see in the stock. So it's a fantastic example of UOA ahead of M&A deals. So let's look at the move here in Kraft after they announced the HNZ acquisition. And believe it or not, there was actually a huge order ahead of that acquisition that telegraphed that move perfectly. So did anybody make any money, or was anybody involved in either Kraft or Heinz ahead of this deal, ahead of this merger announcement? Probably the biggest one we'll see all year. Probably the biggest one we'll see all year, if I were to guess. This is a huge move. Huge move here in Kraft, and I don't see us retirement stocks only. Well, on March 10th, a trader came in and bought 10,000 Kraft June 67.5 calls for 70 cents. Okay, now Kraft trades a lot of stock in a day, but this is a very large order in a stock like Kraft, right? $700,000 bet. Okay, so we automatically know that since this trader is tying up $700,000 in this trade, that they're most likely not someone sitting at home. They're most likely a pro, right? They're most likely someone who is coming in and putting on a big speculative bet in Kraft that the stock continues higher through June expiration. And they actually have a pretty aggressive break-even point there, up at above $68, right? Now, I see that order hit the tape, and this is one that took a little bit longer to play out, right? So a few weeks go by, just 2 weeks go by, the stock kind of languishes and trades sideways for a while, and then the announcement comes in, right? We see unusual option activity in stocks like this all the time, okay? All of the time. Kraft, one that has activist investors involved in it. Traders come in and try and speculate on announcements or moves in these companies using options. Okay, so the longer that you trade unusual options activity, the more used to these you get. You start to recognize, hey, this stock makes sense to try and trade unusual options activity, and because I know that Carl Icahn is involved in it, because I know that Warren Buffett is involved in it, I know that there's always activist rumors circling this name, and there can be a catalyst at any moment. Well, in this case, the Kraft catalyst was they announced a merger with HNZ. They announced they're going to pay a special dividend of like $16 to all of their investors, and the stock explodes higher. These calls go from 70 cents to $22.70 at the highs. That's $200 per one lot in profit. So per 70 cents in risk, a trader makes $2,200 in profit. So on a 20 lot, that would have been a $44,000 profit. Traders in our trading room that had this position were absolutely ecstatic. There was several people in our trading room that saw this trade and took this trade using the unusual option activity trading plan, and had some six-figure paydays. Yeah. I wish I could see your guys' names. For some reason, you all have the same name in here. So, we're about to jump into the actual trading plan here, but let's talk about, again, really quickly, why the order flow is significant and why I want to pay attention to it. So hedge funds and big traders, they simply have more information than us. Whether or not that information is ill-gotten, whether or not it's information that they're supposed to have or not supposed to have, I don't really care, really could not care less. All I care about is that it's information that I don't have and analysis that I can't do, okay? So it's kind of like being able to see what Carl Icahn or David Einhorn's positions are like ahead of ahead of their disclosures or announcements. When we saw Ackman short HLF, before he even announced his short, we saw the orders hitting the tape. At the end of the year, this past year, when he rolled his short forward, we all saw that hit the tape too. And before, 2 days before they were announcing it on CNBC and Bloomberg, we knew that it was happening because we were able to see his order flow on the tape. Okay? What's really important to understand is that all of these trades are public information. As soon as I see an equity options order hit the tape, I can use that order to base a strategy off of, and I have done nothing wrong, regardless of whether or not the person that placed that order did it by getting insider information from by holding the CEO of the company at knife point. It doesn't really matter to me, right? It does not matter. Someone says, so, well, you can't watch everything, so where do you get your information? That's a really good question. We're going to go over that here in a little bit. So we developed a trading plan to kind of focus on the most relevant parts of unusual options activity and how I can use order flow to my advantage. Okay, so the first thing that I want to look at is open interest. Okay, so the O in Oak Ribbit stands for open interest, and this is very simple. So if I see an order hitting the tape, I want the volume of that order to be greater than open interest. So for example here, we see a Pfizer order hitting the tape. Trader buying 1,315 of the Pfizer June 35 calls for 33 cents, right? Well, I can also see that the open interest is 109,000. When open interest is greater than volume, it tells me that it is most likely not an opening position. Okay, think about that logically. If open interest is 5,000 and I see 5,000 calls trading against that open interest, well, they could be closing that those 5,000 contracts out, right? They could be closing those out. I don't want to take their exits. All right. If I see open interest of 0 and I see 5,000 calls trading against open interest of 0, well, there's no contracts there for them to close out, right? So I know that order is an opening position. It is an initiating buyer. Okay, so I want to follow initiating buyers, not traders that are closing their positions. Okay. So the next thing I can do is look at the chart. So how does the stock look on the daily chart? So this helps me determine whether or not an order is a speculative bet or a hedge. I can never know for sure whether an order is a speculative bet or a hedge, but I can use the chart to help determine what is more likely in that scenario. Okay, so if I look at a trade in a stock like in that Kraft stock, well, I can see that when that order hit the tape, Kraft was relatively strong on a chart. Kraft was relatively strong on a chart. If I take a look at the chart, I can see that when that order hit the tape back here at the beginning of March, we were in flat to upward trend, right? So it's not likely that it is a hedge. What I'm looking for basically, and if you're not that into technical analysis, if you don't like to really read charts, you don't really use that many indicators, you can use the Ichimoku cloud, okay? And all I'm really looking for is whether or not the trend of the stock agrees with the option order that is hitting the tape. Okay, so if I see a big block of calls being bought and I see a stock that continues to make lower lows and lower highs and sell off every single day, well, then I know that it's much more likely that a trader is shorting stock and buying those calls as a hedge. Okay, so all I'm looking for in the chart is for the stock trend to agree with the direction of the trade. So someone says, how do I know if the trader is not putting on a spread? Well, all orders that are spreads must be labeled as such. That's an exchange rule. So you'll know, you'll see an order hit labeled as a spread, you'll know it's a spread. Next, risk, reward, and break even. So once I determine that I want to take one of these trades, once I see that order in Kraft at the tape and I determine that I want to buy those calls, I have to determine what my risk, reward, and break even is going to be. So I can measure my risk in one of two ways, either as a percentage of my book or as a total dollar amount. I have to figure out what that is for myself. I then need to determine what my stop losses are going to be. If I am a beginner, I want to be using a tighter stop, okay? I don't want to risk too much in individual positions. If I'm a little bit more of an advanced trader, I can use a 50% stop, risking half the premium in the position. And if I'm an expert trader, I don't need to use a stop because I may choose to add, I may choose to, kind of tweak my position, but that's only for an expert trader. Beginner and intermediate traders should be using stops. Okay? So is everyone following along so far? Is everyone following along so far? Great, 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 great. So, time and target. This is, again, very important. One of the major pitfalls of traders that are first trying to trade unusual options activity is trying to kind of outsmart the institutional trader. Okay? Now, I need to take the same time and targets that they are. So one thing that I can do, like let's say I see those June 67 half calls in craft hitting the tape, I might say, well, hey, you know what? I can buy the, Aprils for much less money. Why don't I just do that, right? But here's the thing: all of that time and analysis goes into that trade before they put that trade on. I don't want to then fly in the face of that and say, okay, I'm just going to change that. It completely negates everything that I think is good about following unusual options activity. So I want to trade the same expiration, and I want to sell if I see the calls being sold. I want to sell them if I see them exiting. So by watching the tape, if I see their unusual order as an entry, I'm then going to keep my eyes open for them possibly exiting that position, okay? Because when they get out, I want to get out too. All right. I also want to put my offers out right away in this position to make sure I'm getting a good potential reward. Okay. So, a lot of you have asked, how do you find these signals? Where are these available to me? Well, option scanners are something that is used by institutional traders all the time because they want to know where block trades are going down, what prices they're trading at, and what symbols they are trading at. They have never been available to retail traders before. Professional traders have not been able to create a scanner that can do the filtering that ours can, that I'm about to show you. So we have a scanner called Option Hacker. And what Option Hacker does is sifts through all of the noise that hits the tape in a given day to find the best possible trade setups. Okay, this technology has taken 12 years to build with 50+ years of trading experience behind it. Okay, now, how does Option Hacker actually filter these trades? So even professional traders have trouble scanning through thousands of orders in a day. All right, it's difficult to do. It can make your head spin. All right, so Option Hacker takes the guesswork out of that scanning and speculation and puts the best potential signals in one place as an actionable alert that a trader of any skill level can then take and use to their advantage. So stop guessing, stop taking bad trades and losing money. You can get the best potential bullish and bearish signals daily using Option Hacker. So this is what Option Hacker looks like in a given day, and we see that all of the orders are right out here for me, available for me to see. And this is exactly what they look like. They all look just like that example that we looked at in ALTR. So this is how many orders have come across the tape so far today on an unfiltered tape. I mean, it's hundreds. And this doesn't even go all the way back to this morning, right? It's hundreds and hundreds, and by the end of the day, it will be thousands of orders that have hit the tape, all right? This is an entire day's worth of alerts on Option Hacker. So it filters these down to a manageable amount that any trader can use, okay? And what we look at are certain criteria that make these trades actionable and actually interesting for us. So that's all of the signals that you would see in a day. Those are the best unusual options activity signals in a very easy to read format. 75% of the people that try Option Hacker renew for a full subscription. They really, really like it. So let's talk a little bit about how we create these alerts and what makes them so good. So one of the things that we do to help filter these alerts is we only show opening positions. So that takes a huge amount of orders off of the table right away. You never have to determine whether or not a position is opening or closing. We tell you because only orders that are opening are going to hit the tape, okay? We've also filtered out orders in stocks that trade too much stock in a day, meaning stocks that don't actually have unusual options activity. It can be very easy to start chasing order flow in stocks like Apple, Facebook, or Twitter, thinking that a 10,000 lot of options is a significant order, but it's really not. Okay, we've also incorporated an Ichimoku cloud analysis into each alert. So our favorite indicator is now available right as a part of Option Hacker. As soon as an order hits the tape, it tells you whether or not it's above or below the cloud. So when I see calls being bought in Kellogg, and I see that it's above the cloud, without even looking at the chart, I know that the chart is going to agree with the direction of this trade. So it shaves time off of my analysis because I don't actually have to look at the chart. We've also added click on charts. So this little chart button here, and I have this is a screenshot, so I can't actually click it and show you. But if you click this little button here on the alert, it'll automatically bring up a chart for you to see. All right. We've also added sound alerts. So if you're kind of looking at a lot of things during a day, you don't have to have your eyes glued to Option Hacker all day to hear the alerts. A noise will be played as soon as an alert hits the tape. Okay. And we also have market color and commentary. So as these trades hit the tape in a day, we also add commentary and kind of color them a little bit via little text blurbs that appear in Option Hacker. Okay. So to use Option Hacker, we include a trading plan user blueprint with your subscription, so you can learn how to use Option Hacker in your everyday trading plan. And we cover how to day trade and swing trade, options and stock using Option Hacker, and how to use those signals to find both bullish and bearish setups in stock and options. So even if you don't trade options but you trade stock, you can use Option Hacker to then trade stock based on these institutional and unusual orders that we see hitting the tape in a given day. So we have some reviews here from our customers about Option Hacker. I just want to read them to you very quickly. So Bala says, Option Hacker gave me a bullish signal on APA July 25 calls for 25 cents. I bought them and sold them at $1.80. Thank you, Option Hacker. That's 900% gains in days. Eric says, thank you for making Option Hacker available. I have strictly day traded stocks for quick moves. Once the alert hits, it's been very successful. So here's someone who uses this to trade stock, not options, with these unusual options activity trades. Hank says, Option Hacker is something that I've always wanted, but never thought I could afford. Information like this usually costs much more. Option Hacker eliminates the huge edge and advantage that the big traders have over small traders like us. Don says, in the first week of my trial of Option Hacker, I constantly watched it produce winning trades at about a 70% rate. It is a great tool to incorporate into your trading. John says, I enrolled to the tool Option Hacker, 30 contracts in hit in DHR for 60 cents, and I sold them at $6. Thank you, Option Hacker. That is 1,000% returns. Ramon says, with Option Hacker, I can now see if a big player is buying a lot of calls or puts, and that helps me either go into the market or sell my open position. Okay, so I want to take as many questions as you guys have, but I do want to offer you guys the opportunity to purchase Option Hacker for a significant discount from our regular website price. So if you go to this link here, KeeneOnTheMarket.com/till-Tuesday, you will be able to purchase Option Hacker for 1 month for $99. Now, that is a huge discount from our regular price. If you go to our website and try to purchase Option Hacker on our website, you are going to have to pay $299 a month just to get the Option Hacker scanner. So this is a huge discount. In addition to, and here's Option Hacker from today. As you can see, it's a little bit of a sideways day, so we only have some trades that hit the tape. But look at an example here, and this is much more typical of the type of orders that we see hitting the tape in Option Hacker on a given day. I told you guys that, we typically don't see every single day a trade where a call goes from 70 cents to $7 or 70 cents to $20, right? But what is much more typical is an order like this. XOMA, a trader bought a big block of these set 4 calls for $1.05 in XOMA. Now, this was a huge trade. It signals as an alert on Option Hacker. And if we take a look at how these calls have traded since then, we can see that the stock ripped higher after these hit the tape. This was one of the first things that hit the tape this morning. These calls ripped higher, and if I take a look to see exactly how high they traded today on the step 4 line, give me 1 second. The step 4 line of calls is already 120 bid at 125. Okay, it's already 120 bid at 125, and they've traded as high as 125. So that's a 25-cent gain on a $1.05 option in just a few hours. Okay, Fantastic, fantastic returns for anyone that likes to day trade options. So does anyone have any questions about anything that we just went over here? Anything about Option Hacker, anything about the trading plan? In addition to access to the Option Hacker scanner, and you can use this with any platform that you have. It's a web-based standalone platform. In addition to the Option Hacker access, I don't know why that keeps happening. I'm sorry. In addition to the Option Hacker access, you also get, with your purchase of Option Hacker, access to the trading plan and blueprint that we wrote with it. So if you purchase this, you get 1 month of Option Hacker that renews at $199. So if you decide that you don't want to keep it, you can cancel after the 1 month, or if you decide you do want to keep it, you get $100 off per month in perpetuity going forward. But you get the Option Hacker workshop, you get the Option Hacker blueprint, and the Option Hacker cheat sheet. So everything that you need to start implementing Option Hacker in your everyday trading plan. Someone says, please put the example of the call order again, explains the details of the order. All right, here I can actually just even better. I can show you the Option Hacker order and what it looks like. So here we have an order that hit Option Hacker, and let's break down this XOMA one because this is so profitable. So what we can see here, when each order hits the tape, it's automatically labeled as a bullish or bearish trade. So if you're someone who's only looking for bullish trades or only looking for bearish trades, you can pretty easily filter out all the ones that you don't want to pay attention to on Option Hacker, okay? Then it shows us the size of the trade, the expiration and the strike, and what they paid. It also shows me the market at the time of the trade. So I see the market was 95 at 105, meaning that they paid the offer to get into this position. They paid the offer, they lifted the offer to get into this position. They wanted to get the trade, okay? Then I can also see what the delta was. I can also see where the stop was, and I can also see the open interest. Open interest becomes less important with Option Hacker because it's never going to show me a trade that isn't an opening position, okay? It's never going to show me a trade that isn't an opening position. I'm going to put the link in here again for you guys. Yes, none of these are spreads. None of those are spreads. It's showing me single, outright speculative bets that I can use then in my trading plan to either trade stock or to trade options. So any other questions you guys have? Any other questions? This is a fantastic, fantastic deal. We have not offered Option Hacker for this price probably since so after your trial of $99 for the first month, it is $199 a month after that, but that's still a $100 discount from our regular price. Someone says, does KOTM's unusual option activity screener screen for options with deltas less than 50 or calls with less than 50 delta for puts? Because they're usually the speculative bets. No, so we have a delta analysis that we do to kind of filter out the deep in the money stock replacement bets. But what we do try to focus on are the speculative bets here, and there's a lot more that goes into it than just a delta analysis. So someone says, how does this compare to Sizzle? So a Sizzle index, or something like a Sizzle index that you would see in Thinkorswim or another platform, that's something that's not really going to give me actionable trading ideas. Okay, it's going to tell me simply where a lot of volume is going down, right? Where there's a lot of trading happening. That doesn't necessarily tell me what the intent behind all of that trading is. What Option Hacker does is it filters out all of the noise, shows you only the opening orders, and also shows you whether or not they are likely to be, unusual, right? And then gives you a trading plan to then say, okay, now that I have this information, what do I do? Makes sense? Makes sense, makes sense. So the Sizzle, a Sizzle index, looking at something like that, that doesn't really give me nearly as much information as Option Hacker does. So any other questions, guys? Any other questions? like I said, this is a fantastic deal. Option Hacker website. Yeah, you can go to the website.